Please come to the case study after that modification paragraph. A lessee enters into 10-year lease for 2000 square meter of office space. At the beginning of year 6, lessee and lessor agree to amend the original lease for the remaining 5 years to include an additional 3000 square meters of office space in the same building. So in this problem, first thing is there is an additional space hired. Two conditions needs to be satisfied so that you can account it as a new lease. Okay. First is that it must increase the scope of the lease. Second, the consideration should be based on standalone price. So first is there is an increase in the scope. The additional space is made available for use by the lessee at the end of second quarter of year 6. The increase in the total consideration for the lease is commensurate with the current market rate for the new 3000 square meter of office space, adjusted for the discount that lessee receives, reflecting that lessor does not incur cost it would otherwise have incurred if leasing the same space to a new tenant, for example, marketing cost. Condition number 2 is also satisfied. Here there is an additional space rented out and the lease rental is based on current market rate, adjusted for marketing costs that the lessor would save. Will this lease be accounted as a separate lease? You will say yes. This modification will be accounted as a separate lease, separate from the original 10-year lease. So you will have two leases working now simultaneously. This accounting will continue as it is, and this new lease will be accounted as a separate lease. This is because modification grants lessee. Modification grants lessee an additional right to use an underlying asset, and the increase in consideration for the lease is commensurate with the stand-alone price of the additional right of use, adjusted to reflect the circumstances of the contract. In this example, the additional underlying asset is the new 3000 square meter of the office space. So first condition is satisfied, increase in the scope of lease, and second condition, the consideration should be market price, stand-alone price. That condition is also satisfied. Accordingly, at the commencement date of the new lease, that is the end of the second quarter of year 6, lessee recognizes a right of use asset and a lease liability relating to the lease of additional 3000 square meter of office space. Underline, lessee does not make any adjustment to the accounting for the original lease. So original lease will remain at its own place. That will continue as usual. Plus you will have to open one more account for this additional lease. So this was an example of modification resulting into a new lease, and therefore it will be accounted as a new lease. Next paragraph. Lease modification that are not accounted for as a separate term, separate lease. If either of the two conditions are not satisfied or both conditions are not satisfied, then the lease modification will not be accounted as a separate lease. Rather, you will make adjustment in the original lease, existing lease accounting only. So next paragraph. For a lease modification that is not accounted for as a separate lease. So first you check whether those two conditions are satisfied or not. If one or both are not satisfied, then you come to this paragraph. For a lease modification that is not accounted for as a separate lease, at the effective date of lease modification, lessee should allocate the consideration in the modified contract applying the requirement of this standard. So again you have to make a list of the consideration that you have to pay. Okay. So what will be your consideration in the modified contract? For example, you may have to pay 50,000 instead of 40,000. In some problem, the lease term may get modified. You determine the lease term of the modified lease. So it may become 8 year. From 8 year it may become 10 year. From 8 year it may become 6 year. And remeasure the lease liability. So one is you have to make a list of the cash flow that will get altered. Okay. Second, possibly the lease term may also change. Third thing, you have to recalculate the lease liability by discounting the revised lease payment using a revised discount rate. Okay. So your cash flow will change, lease term will change, discount rate will change. So you do the recalculation and then that will give you what is the increase in the lease liability or decrease in the lease liability. And accordingly we'll do the accounting. But then you don't have to open a new account. Your existing lease liability and existing right of use asset, those will only be changed. The lessee should account for the remeasurement of the lease liability as follows. For lease modification that decrease the scope of the lease. For lease modification that decrease the scope of the lease. So earlier, for example, the lease was for 3,000 square feet area. Lease modification reduced it to 2,000 square feet area. So that is called decrease the scope. Or earlier lease was for 8 year. Now you reduce it to 6 year. Yes or no? So that is also a decrease in the scope of the lease. Then in that case what will happen? Will my liability increase or decrease? If I reduce the area from 3,000 square feet to 2,000 square feet, will my liability decrease or increase? Most probably decrease only. Because if you are paying 3 lakh rupees for this area, maybe you will pay 2 lakh for this area or 2,10,000 for this area. At least some amount will be lower. If it was 8 year, so you are going to pay the consideration for 8 years. Now you are going to pay consideration only for 6 times. So then also the chances are that your lease liability will decrease. So by decreasing the carrying amount of the right of use asset, one entry will be right of use asset will decrease. So credit this account to reflect the partial or full termination of the lease, and any gain or loss relating to partial or full termination of the lease should be accounted in the profit and loss account. So you will pass one entry, decrease in lease liability, debit, decrease in asset. If these two does not tally, then the difference will be transferred to profit and loss account. Okay. So if the carrying amount of the asset, lease, this asset ROUA, carrying amount on the date of modification is 3 lakh rupees for a 3,000 square foot, then if the area changes to 2,000 square foot, what we will do? We will reduce the carrying amount of the right of use asset proportionately. If there were 2 floors and now one floor we have returned. Now only one floor is left. Assuming that everything else is same, we will reduce the carrying amount of this right of use asset proportionately, means it will become 1 by 2 now. Is it right? And that is why the gain or loss will arise. These two figures will not be the same. And for all other lease modification, making a corresponding adjustment to the right of use asset. In case of modification other than decrease in the scope, change in the lease liability will make adjustment in the right of use asset. Two types of problem we will face now. One where the scope of the lease increases. Second, the scope of the lease decreases. And how to do the accounting? And it does not result into creation of a new lease. If it results into creation of a new lease, then my life is simple. The original lease will continue and the new lease will be accounted as if it is a new asset. Okay. Difficulty will arise when the same lease will have to be modified. But no problem. Compute the revised cash flow, revised term, revised discount rate. That's it. Okay. So modification that increases the scope of the lease by extending the contractual lease term. So what we are going to do, we are going to increase the lease period from 10 year to 15 year in this example. Come to this question printed just below that. Lessee enters into a 10-year lease for 5,000 square meter of office space. The annual lease payments are currency unit 1 lakh payable at the end of each year. Underline payable at the end of each year. So this is good. The interest rate implicit in the lease cannot be determined. Lessee's incremental borrowing rate is 6% per annum. At the beginning of year 7, the lessee and lessor agree to amend the original lease by extending the contractual lease term by 4 years. By extending the contractual lease term by 4 years. What was the original lease period? 10 years. Now they have added 4 more years to this. So the total lease term will become how much now? 14 years. How many years are already over? 6 are already over. Because at the beginning of year 7 they are making this modification. So how many years are remaining now? 8 years are remaining. The annual lease payments are unchanged. The lease payment will remain 1 lakh only. Payable at the end of each year from 7 to 14. Lessee's now incremental borrowing rate is 7%. So 3 figures we have to remember. We have to find what will be the cash flow. So cash flow will be 1 lakh per annum only. What will be the number of years? 8 now. 8 years are remaining. And what will be the discount rate now? So now the discount rate will be 7%. So based on these revised figures, you have to do the calculation. So at the effective date of the modification, that is at the beginning of year 7, lessee remeasures the lease liability based on 8-year remaining term, annual lease payment of 1 lakh and incremental borrowing rate of 7% per annum. Now take your calculator. First you type 1 divided by 1.07. Press equal to 8 times GT into 1 lakh. Are you getting 597,130? That is 1 lakh multiplied by PV, annuity factor, 7%, 8 periods. Is it right? Say yes or no. Then only we can move forward. Right. The lease liability immediately before the modification was how much? Now let us check what was the lease liability immediately before the modification. What was the original lease term? 10 year. 6 years are over. 10 year was the original lease term. 6 years are over. Completed period is 6. So how many years are remaining? Remaining 4. So now you tell me 1 lakh into PV annuity factor, 4 year and original discount rate was 6%. So in my books of account, the existing carrying amount of the lease liability is, now type on your calculator 1 upon 1.06, press equal to 4 times, GT multiplied by 1 lakh equal to, is it 346,511? Yes. So now you have understood two calculations. Whenever there is a modification, first you will have to find out what is my carrying amount of the liability and asset on the date of modification. Find out the new liability now. What is your new liability here? 597,130, which means your liability will increase by 250,619. Lessee recognizes the difference between the carrying amount of the modified lease liability and the carrying amount of the lease liability before the modification as an adjustment to the right of use asset. Check the difference. Is it matching? 250,619. Journal entry. Why we will record it as a separate lease? Why haven't? Oh, that's a good question. Because it is just the same lease which has been extended. Okay. And who knows, after 6 years the rent will still remain 1 lakh rupees or not. If the property rent is 1 lakh right now, after 6 years it may not remain 1 lakh. It might have become 5 lakh or 3 lakh, but still the old rent has been given, which means it may not be as per the stand-alone price. So that is probably the reason. Okay. Do you think rent after 6 years for the same property will still remain same? Possibly. Yes also, no also. So you assume no. Now my next question is, what about the journal entry? This is not typed in your notes. Tell me, journal entry. Right of use asset debit 250,619 to lease liability 250,619. So in this example, there is an increase in the scope of the lease term, but we have decided not to treat it as a new lease. So write down assumption. It is assumed that the modification does not meet the requirement of new lease. Modification does not meet the requirement of new lease. Now next question is very important. Modification that decreases the scope of the lease. Modification that decreases the scope of the lease. Like for example, from 3000 square foot, you may reduce it to 2000 square feet. From 8 years to 5 years. From 2 floors to 1 floor. Something like this. Okay. Then in that case, now what you will do? You will revise your lease liability. Again based on new data, new discount rate. But what about the asset? Asset will be reduced proportionately. Asset will be reduced proportionately, because if suppose you are holding 2 floors earlier and your right of use asset was, say for example, 2 lakh. So now if you are holding 1 floor only, the value of the asset should be proportionately changed here to 1 lakh. But the lease liability may not change like this. So there will be a decrease in lease liability. That is a separate calculation based on revised cash flow, revised term and revised discount rate. Asset value will change proportionately. The two figures will not match. So difference will be transferred to profit and loss account. This P&L account will come for decrease in the scope of the lease and will not come for increase in the scope of the lease. In the previous problem, if you see, I'll go to previous page. There was an increase in the scope. So here I will adjust in the asset only, whatever additional liability comes. But the decrease in liability here I will not adjust entirely in the asset, because we have to also see that the asset value will change proportionately. Now we will solve one small case study. Lessee enters into 10-year lease for 5,000 square meter of office space. Annual lease payments are currency unit 50,000 payable at the end of each year. So what is my area occupied right now? 5,000. How much rent we are paying? 50,000. Okay. And it is for 10 years. Payment is made at the end of the year. Lessees incremental borrowing rate of interest 6% for our discounting at the commencement. At the beginning of year 6, lessee and lessor agree to amend the original lease to reduce the space to 2,500. Now what was earlier? 5,000. 5,000 to 2,500 means half. Half space will keep, half space will return back of the original lease starting from end of the first quarter of year 6. The annual lease payment from 6 to 10 are 30,000. Lease rental will also change, but lease rental is not reduced proportionately. What the lessor has done, if you take 5,000 square meter, 50,000, but if you take 2,500, then he will charge you now 30,000. The lessee's incremental borrowing rate has also changed. Now it is 5%. What it was earlier on commencement? 6%. So at the effective date of modification, that is at the beginning of year 6, the lessee remeasures the lease liability based on how many years are remaining? 5 years. What is the lease payment now? 30,000 rupees per annum. What is the revised discount rate? 5%. So take your calculator. 30,000 into present value annuity factor 5% and 5 years. Do this calculation. Check, are you getting this number? Is it right? So now my lease liability will be 129,884. Correct? For the remaining period, remaining rate, remaining cash flow, the lease liability now should be 129,884. Lessee determines the proportionate decrease in the carrying amount of the right of use asset on the basis of remaining right of use asset. Now earlier it was 5,000, now it is 2,500. So that means there is only 50% of the original right of use asset is remained. Okay. So what will be the proportionate calculation of 50% of the pre-modification right of use? Now there is a calculation requirement here. First you have to see what was my original lease. Original lease was 10-year lease, 50,000, 6% discount rate. So tell me first, what is the original amount of right of use asset which was capitalized here? Right of use asset capitalized at the beginning. Keep writing whatever you want. Capitalized at the beginning will be 50,000 into PV annuity factor 10 years and 6%. How much you said? 3 lakh? 3,68,004. How many years are over? 5 years are over. So what will be the right of use asset carrying amount after 5 years? 5 years are over, means half of it has been depreciated. 1,84,002. This is my carrying amount right now for 5,000 square meter. After that, we have given away 2,500 square meter, which means out of 184,002, I will reduce it to now 92,001. Half of it I will retain in the books and half of it I will derecognize. Half of it I will retain and half of it I will derecognize. So now my carrying amount will be 92,001. What about the pre-modification lease liability? Pre-modification lease liability, 50% of the pre-modification lease liability. Let us calculate that also. For that you just calculate 50,000 into PV annuity factor. First calculate 10-year 6% and then you divide by 2. So reduce the lease liability. Is it right? 105,309. So are we gaining or are we losing by removing 50%? Gaining. Liability has reduced more, asset has reduced less. So consequently the lessee reduces the carrying amount of the right of use asset and the carrying amount of the lease liability by 105,309. But here you have done one calculation, 129,884. So now you can pass entries in either one way or two ways. So first entry will be, first entry write down, lease liability account debit, (105,309) to right of use asset 92,001 to gain transferred to P&L account 13,308. But the story is not over. Story is not over because you have to bring your liability to what value? Your liability has to be brought to 129,884. Is it right? But you have reduced it to 1,05,309. After passing this entry, your liability in the books is 1,05,309, but it has to be 1,29,884, this number. Okay. So you have to pass one more entry. Lessee recognizes the difference between the decreases the remaining liability of 1,05,309 and the modified lease liability, which is 129,884, equal to 24,575. Check, is it right? As an adjustment to the right of use asset, reflecting the change in the consideration paid for the lease and the revised discount rate. So write down one more entry. Right of use asset account debit 24,575 to lease liability 24,575. Written journal entry. First entry, you de-recognize 50% of asset and liability. Because liability is measured separately, asset is measured separately, some difference may be there. And then you bring the liability value to your desired value by giving a corresponding second effect in right of use asset. Is it right? So this is my question where you will have to recognize gain or loss in P&L account if the scope of the lease decreases. Now come to next case study, modification that both increases and decreases the scope of the lease. Simultaneously two events are happening. And now we will assume that the same lease will continue, no new lease. Okay. So that condition we will assume that no new lease. How it is possible that both increases and decreases the scope of the lease? For example, the area under the lease may be increased from 2,500 square feet to 5,000 square feet. But the lease term may reduce from 10 years to 8 years. Okay. So something like this, or reverse can also happen. Area may reduce, lease term may increase. So we have to give the effect of both the situation now. For decrease in the scope, some gain or loss will be recognized. And for the increase in the scope, the change in liability will be adjusted in the carrying amount of the right of use asset. So a lot of number crunching gets involved in such calculations. So a very important question in front of you. Modification that both increases and decreases the scope of the lease. And little lengthy also. Keep calculator ready, pencil ready if you want to write something. Lessee enters into a 10-year lease for 2,000 square meter of office space. The annual lease payment are CU, currency unit, 1 lakh, payable at the end of each year. Payable at the end of each year. Underline payable at the end. So my calculation is simple. 10-year original term, area 2,000, lease rental 1 lakh, frequency, annual payment at the end. Lessee's borrowing rate 6% per annum. So this is my original question, very easy. at the beginning of year 6, means 5 years are over. So what you will have to do, whenever there is a modification, then you find out on the date of modification two things. What is my carrying amount of liability? What is my carrying amount of asset? That you can do. Lessee and lessor agree to amend the original lease to, now see what are the changes, to include an additional 1500 square meter of space in the same building. So this increases the scope of the lease. Starting earlier it was 2500, now additional 1500 starting from the beginning of year 6. And second, reduce the lease term by from 10 years to 8 years. Now it was 10. In future it will be 8 year only. But the area occupied will become 3500 square meter now. The annual fixed payment for 3500 square meter is 1,50,000. Payable at the end of each year. That means payable in the year 6, 7 and 8. 3 years are only remaining now. So lessee's incremental borrowing rate is also now 7% per annum. So my revised data is I have to pay 1,50,000 for 3 more years at 7% per annum. Earlier I was paying 1 lakh rupees. Earlier I was paying how much? 1 lakh. Now I am paying 1,50,000. So what is the additional rent I have to pay now for additional space? 50,000 rupees I have to pay for that additional space. So that is purely due to increase in the scope of the lease, 50,000. 1 lakh I was paying in any case. Okay. So the consideration for the increase in the scope of 1500 square meter of space, now see this they have mentioned in the question, is not commensurate with the standalone price for that increase adjusted to reflect the circumstances of the contract. So condition number 2 is not satisfied. Hence, no new lease. Very good. Consequently, lessee does not account for the increase in the scope adds to the right to use an additional 1500 square meter of space as a separate lease. So no new lease accounting. We have to modify the existing lease accounting only. Have you understood the case? Originally it was 2000 square meter, now it is 3500 square meter. Earlier we were paying 1 lakh rupees, now we'll pay 1,50,000 rupees, 50,000 more for additional space. Earlier the lease term was 10 year, now it is 8 year. 5 years have already expired. So now only 3 years are remaining. Okay. Okay. So first what you do? First you take your calculator and find out what is the value of the liability and the asset at the beginning of year 6. So on the screen you see this lease liability calculation. Asset you can directly find out in one line also. So first you have to take your calculator and find out what is the opening lease liability. 1 lakh into present value annuity factor. Original lease term is 10 year and original discount rate is 6%. So dear student, take your calculator. 1 divided by 1.06 equal to 10 times. Press GT function. You will get some factor multiplied by 1 lakh equal to 7 lakh, 36,009 you are getting. This working note first you will prepare. Opening balance of lease liability and right of use asset based on original numbers. Now bring this number here in this table. Calculate 6% interest. Is it 44160? Lease payment is 1 lakh minus 1 lakh. So what is the closing balance? Keep checking. 680, 169. Next year try 680, 169, 6%. Is it 40310? 1 lakh payment, check the balance. 620, 979. Okay, take 6%. 37259, payment 1 lakh, check balance. 558, 238. Keep checking. 558, 238, 6%. 33494, 1 lakh paid, check balance. 491, 732. 491, 732, 6% interest, payment made, balance. Okay. So what is my balance now? 421, 236 in the lease liability account. This is my balance based on original data after 5 years in the lease liability account. After 5 years or at the beginning of year 6. Agreed? What about the asset? Asset, you just simply take 736,009. How many years are over? 5 are over, 5 are pending. Which means my carrying amount after 5 years should be half of it. How much is that half of it? 368,004 approximately. So for this, what you will do in the exam, suppose you don't have time, then don't prepare that full chart unless they specifically ask you to show the balance in the asset account at the end of each year or past journal entry, etc. You can simply make it working note 2. First working note you will write lease liability at the end of year 5. Second working note you will write the right of use asset carrying amount at the end of year 5. So these two numbers you keep in mind for further discussion. Any query now? No. So step 1 you understood. Find out the carrying amount of the liability and the asset at the end of the year 5, or you can say on the date of modification for generalization purpose. For generalization purpose, find out the two balances on the date of modification. Now you see what is the revised data. After the change in the lease term, change in the terms and condition, that is modification, what is the revised data? Lessee remeasures the lease liability on the basis of. So what they are saying now, 3 years will be the remaining lease term. Annual payment will be 1,50,000. Incremental borrowing rate will be 7%. So combine these three numbers and find out now what would be the lease liability at this point of time. So take your calculator, 1,50,000 into PV annuity factor 7%, 3 years. 1 divided by 1.07 equal to then GT into 1,50,000. How much it comes to? 393,647. Keep writing whatever you want to write. Afterwards you will not be able to remember. So your next working note 3 will be to find out what will be the modified liability. Okay. How much liability do we want now in the books? 393,647. But in this problem, the scope of the lease has increased also and decreased also. Okay. So we'll have to give the effect of decrease in the scope also. So for that purpose, this 1,50,000 that we are going to pay on the screen, pay attention, we will divide this calculation into two parts. One part is 50,000 increase in the scope, and the second part is for decrease in the scope, 1 lakh. Okay. This 50,000 into PV annuity factor 7%, 3 years. and this 1 lakh into PV annuity factor 7%, 3 years. Check the calculation, they have given it to you. You can divide in the ratio of 1:2 actually. 50,000 is to 1 lakh. Mathematically, there are so many ways to reach the answer. Check, is it right? Have you checked or just nodding your head? Where? Okay. So this is 131,216. This is 262,431. If only the lease term would have changed, my liability would have become 262,431 at the revised rate. Okay. Now we will see the effect of decrease in lease term at the effective date of modification. At the effective date of modification, that is at the beginning of the year 6, the pre-modification right of use asset is 368,004. What is the value of right of use asset? 368,004. How many years are remaining? 5 years are remaining. But after the modification, how many years are remaining? 3 years are remaining. So my proportionate value of asset will change like this. When 5 years was remaining, I had to recover 368,004. Now only 3 years are remaining. So I will have to reduce the value of the asset proportionately. So that's a complicated calculation here. Pay attention. Lessee determines the proportionate decrease in the carrying amount of the right of use asset based on remaining right of use asset, the original 2000 square meter of office space, that is a remaining 3-year lease rather than the original 5-year lease term. Compare it with the previous example. In previous problem that we solved, the area had reduced from 5,000 to 2,500. Here the lease term has reduced from remaining 5 years to 3 years. So what we will do, the remaining right of use asset for original 2000 square meter of office space will be, see this calculation, continuously pay attention. Your current book value is, we are talking about asset right now, 368,004. How many years are remaining? Originally 5. So divide by 5. And how many years are now remaining after the lease term? 3. So that means 3 by 5 of my carrying amount should remain in the books. 3 by 5 of the carrying amount should remain in the books. So how much is that 3 by 5 of 368,004? 220,802. Okay. So this is what I want right now in the books of the account for right of use asset for decrease in the lease term. Now come to the liability. So tell me by what amount I have to reduce my asset because of modification in the lease term. You are not responding. What amount? By what amount I should reduce my 147,202? This will be decrease in right of use asset. Okay. Let us see the liability also. The original liability. At the effective date of modification, the pre-modification lease liability is 421,436. Where is this number? In your table. Last line, year 6 opening balance. Is it there? 421,236. Now the remaining lease liability for original 2000 square meter of office space is 267,301. what you have done, you have reduced the lease term from 5 years to 3 years. So present value of the original lease liability for the reduced term would have been 3 year and 6% originally. For some minute you now remove that 50,000 increase in the lease liability additional space. Only visualize if the lease liability would have reduced. Lease term would have reduced, lease term. What would be my revised lease liability now? So my revised lease liability would have been 1 lakh into PV annuity factor 3 year and 6%, or you can do the proportionate calculation also. Calculate how much it comes to. 267,301. Is it right? 267,301. Say yes or no. And what is your book value? 421,236. If lease term would have got reduced, your liability would have become 267,301. Correct? What is the change in the lease liability? 153,935. So we have two numbers now to understand. If you continuously pay attention, you will understand. Carrying amount of the right of use asset will reduce by 147,202. This is right now for original lease. And carrying amount of the lease liability, would have reduced by 153,935. Calculate carrying amount of the asset at the end of year 5. Compute the proportionate carrying amount required. Difference is reduction in right of use asset. Find out the carrying amount of liability at the end of year 5. Find out the present value of the liability on the basis of revised term. Okay. So it comes to 153,935. So I will gain or lose? Gain, because reduction in liability is more than the reduction in asset. So what is the difference between these two numbers? 153,935, reduction in liability, and reduction in asset 6733. So the journal entry to be passed would be, which we learnt in the previous problem also, if only the lease term would have reduced, if only the lease term gets reduced in this problem, for example, you will first calculate the gain or loss due to change in or reduction in scope. This is how you will do the calculation. Reduction in the asset, calculate 147,202. Reduction in liability 153,935. And the difference, gain, you will transfer to profit and loss. Story is not over. This is only for decrease in the scope, gain calculation. Now I will go to some earlier slide to understand. Now see on the screen, there is a small diagram here. 1 lakh rupees was the original rental, 1 lakh per annum. Using the revised discount rate, because there is a modification, I will use the revised discount rate. This original liability would have been 262,431. 262,431 should be the liability. For some minute, ignore this. This is very easy. This I'll just pass one entry and the matter will be resolved. Liability now, after revising the lease term at revised discount rate, should be 262,431. But how much you have reduced it to? You have reduced it to 267,301. You have reduced it to 267,301. This is right now the balance in your book. for the liability. After passing this entry, your balance in the books of account will be 267. How much was that? 267,301. But it should be 262, 431. 262, 431. So some more adjustment is required in the liability. Okay. So now is at the effective date of modification, at the beginning of year 6, lessee recognizes the effect of remeasurement of remaining lease liability reflecting the revised discount rate of 7% per annum, which is 4870. How this 4870 has come? After passing the previous entry, my liability is 267,301, but it should be 262,431. The original liability of 1 lakh rupees, and that difference is 4870. Entry, you have to reduce the liability. You have to reduce from 267 to 262. You have to reduce the liability. So liability account debit to right of use asset 4870. Now understand, suppose in this question only the lease term would have got reduced. In this question, suppose only the lease term would have got reduced. This is what your answer would be. Is it right? You first, again I will revise, first calculate the carrying amount of asset and liability at the end of year 5. Calculate the proportionate amount of asset based on remaining life. Okay, now divide by remaining life originally. That is the proportion. Then calculate the reduction in the liability due to change in the lease term using original discount rate. That difference will go to P&L account. Calculate the liability using revised discount rate. That difference will be adjusted in carrying amount of the asset. This will be the answer for revised lease term. But if there is a scope increase, then calculate additional liability. So again you go to that original question here on the screen. Our scope has increased, so my liability has increased by 50,000 rupees. So 50,000 into present value factor means my additional liability would be 131,216. One more entry for 131,216. Right of use asset account debit to lease liability 131,216. Okay. And after that, your lease liability balance will become 393,647. What we computed at the very beginning, just below the table. Is it 393,647? Say yes or no. You can check it also. You want to check? Or you understood? Sir, where is 393,647? Dear student, it is here only. After the table. And you calculate it using your accounts also. In my books of account, right now the figure is 421,236. Take this on your calculator. And 3 entries I have passed in this lease liability account. Which 3 entry I have passed in this lease liability account? One was for reduction in liability due to reduction in lease term, minus 153,935. Second was remeasurement of this lease liability at the new discount rate, again reduction 4870, and plus increase in the lease liability due to increase in the scope 131,216. Add 131,216. Is it equal to 393,647? Yes. Or directly it is just the present value of 1,50,000 for 3 years at 7%. And in case if they ask in the exam to prepare the lease liability statement till the end of year 8, so now what you will do, just check the numbers fast. 7% interest, Now the payment will be 1,50,000 and your balance is 271,203. Seventh year, opening balance 271,203, interest 18,984, payment 1,50,000, balance is 140,187. In the last year, what you will do? You can make this interest as a balancing figure. If it is not tallying, and make it equal to 1,50,000, close that account. Asset account is very easy, assuming straight line method. Now your revised asset balance, this will be a revised asset balance. Just check it again. Is it right? How do you reach this magic number? My closing balance after fifth year was 368,004. Type 368,004 and 3 entries we have passed. First entry we passed was a credit, means minus 147,202. Second entry also credit, minus 4870. And the third entry was plus 131,216. So is it 347,148? This amount divided by 3. 115,716. So you'll depreciate 115,716 every year, and after the end of the 8th year, both account balance will become 0. Over. You'll be able to solve in the exam now. One more case study, which will not change the scope of work, but which will change the consideration only. So one day lessor comes and says, "Dear lessee, I will charge you a higher rate, or I will charge you a lower rate." Both are possible. So in this case, what I'll do? I'll just compute my revised lease liability based on revised cash flow, revised term, and revised discount rate. Compare it with the carrying amount. Compare it with the carrying amount on the date of modification. The difference you adjust in your liability and asset account. You will calculate gain or loss only if there is a reduction in the scope of the lease. In other cases, the adjustment of change in liability will be made in right of use asset. So take this small simple case study. Lessee enters into a 10-year lease for 5,000 square meter of office space at the beginning of year 6. Lessee and lessor agree to amend the original lease for the remaining 5 years to reduce the lease payment from 1 lakh to 95,000. Interest rate cannot be determined. Incremental borrowing rate is 6%. The revised incremental borrowing rate is 10%. The annual lease payments are payable at the end of each year. Very simple. So my calculation will require two things. First, what will be my carrying amount based on original figures at the end of year 5? And what should be the liability based on revised figures? Okay. Dear student, check. Correct. You have checked also. Let me also check. So my revised data would be remaining 5-year lease term, annual payment 95,000, 7% borrowing rate. Lessee recognizes the difference between the carrying amount of the modified liability. Now how this number has come? 95,000 into PV annuity factor, 7%, 5 years. Check. Done. And the liability immediately before modification. How this figure has come? 1 lakh into PV annuity factor, 6%, and 5 years. 1 lakh into PV annuity factor 6% 5 year. Is it right? And the difference between these two figures is 31717. Where will you adjust it? Asset and liability. What entry will you pass? So write down the journal entry. Lease liability account debit. (31717) to ROUA 31717, right of use asset. Shortcut is not allowed in the exam. You will write right of use asset. Okay. Oh, what a relief. We have completed 50% of the standard in the books of lessee. Now the remaining 50% is in the books of lessor. In case if you have studied the previous lease standard, it is same. I don't think there are major changes. It is so minor that you can't even understand where is the change also. Okay, so lessor accounting will be like previous standard only. So now there is a problem that will happen when you will do the reconciliation. The balance in the books of lessee and the balance in the books of lessor may not match only. Because here we will follow the old method of accounting, operating lease, finance lease, and so many things that you have discussed. So therefore, this will create a problem in case of consolidation also, which is now not in the scope of this work. If the subsidiary has given the asset on lease to parent company, the subsidiary may apply the lessee accounting part. So they will show right of use asset. And suppose it is an operating asset, the other party will also show the asset in the books. The lessee will show right of use asset for the same asset. And in operating lease, the lessor is also going to show the asset. Okay, so this kind of issues will arise in future in group accounting. So now we will not discuss that part, that you keep thinking. Lease classification. A lessor would classify the lease into either of the two. But there is not a choice, you have to apply the standard. And if it meets the definition of finance lease, then you apply finance lease accounting. If it does not meet the definition of finance lease, then you apply operating lease accounting. That means it's not a policy choice, it depends on the terms and condition. Operating leases are basically short-term leases, whereas finance leases are usually long-term leases. So what is the difference between operating lease and finance lease? Operating leases are usually short-term arrangement. Okay. And where the rent received is directly transferred to profit and loss account. It is like you have a car, you give it on hire for 3 weeks. You get some higher charges out of it. Transfer to P&L account. Okay. So it will be treated as income directly and it will affect your profit and loss account. The asset remains in the books of the lessor. Okay. Second type of lease, that is finance lease, they are more like a financing arrangement. Although you call it a lease, but it is not lease. It is more like a financing arrangement. Now suppose you give a car on lease under this for 5 years and you charge 1,50,000 into 5 rent, 7,50,000. For you, the cost of the car was say 4 lakh rupees only. So what you have done actually in the second example, it is not a rental arrangement. It is like you have given a loan only 4 lakh rupees and you are recovering it in the form of 5 installment of 1,50,000. This difference that you got is a form of finance income. Had you given him a loan and he would have paid you installment, the matter would have been the same. So in substance, it is a financing arrangement. So it should be accounted like a financing arrangement. Instead of transferring 1,50,000 rupees to P&L account, I will bifurcate into the interest and the principal amount. It is as if he is refunding me the installment. The interest portion goes to P&L account and the principal portion reduces the receivable. Okay. And what about that asset which is given on lease? It is treated as if we have sold the asset. As if. Even though legally we may not have sold the asset, but for accounting purpose that asset will be derecognized. In that place receivable will appear. Amount receivable from lessee would appear and the asset given on lease will be derecognized here. So that is in short what you will do in operating and finance lease. At the date of inception only, at the date of inception, remember the first day, date of inception, date of commencement. Date of inception means when the parties enter into the agreement or commit to principal provisions of the lease agreement. On that day, the lessor has to decide whether it is an operating lease or a finance lease, and that classification continues unless there is any modification. Okay. Some estimates may change. For example, the life of the asset, economic life estimate, residual value estimate may change. Change in estimate will not give rise to a new classification. Change in estimate will not give rise to a new classification, but the change in the terms and condition of the lease, like for example, it was 3-year lease, you made it 10-year lease now. So that might convert an operating lease into a finance lease. Earlier rent was 30,000 rupees, now you made it 1 lakh rupees. So again it may make an operating lease into a finance lease and vice versa also. But estimates like useful life, residual values, they are estimates. Change in the estimate does not change the classification of the lease. If a lease contract includes terms and conditions to adjust the lease payment for a particular change that occur between inception date and commencement date. So sometime there may be some change that might occur between commencement date and inception date. For example, a change in the lessor's cost of underlying asset or a change in the lessor's cost of financing the lease. For the purpose of classifying the lease, the effect of any such change is deemed to have taken place at inception. So between inception and commencement, if there is any change, you assume that this change is on the date of inception and do the classification accordingly. Example, the cost of financing may change, the cost of the asset may change. And then there is an author's note here. There may be time lag between inception date and commencement date. And the amount involved in the lease arrangement may change between the two. The most common when the asset is being constructed and the final cost is not known at the inception. On the inception date, in any case, we don't do the accounting. On the inception date, we only identify the type of lease. So accounting will begin only from commencement date, even if they fall into different accounting period. For classification purpose, inception date will be taken. What about the lease acquired in a business combination? So two standards will come into play here. So this paragraph is there in one more standard, that is business combination. And if you have studied business combination in detail, and if you remember, there is an exception there. Normally in business combination, assets and liabilities are recorded at fair value. But there is an exception. If you acquire another entity and that entity have already entered into a lease arrangement. So will you look at the classification on the date of acquisition, or will you look at the original classification in the books of acquiry? Original. That means whatever is the classification in the books of acquiry will be continued. So this sentence in the center, the subsidiaries lease will be classified in the consolidated financial statement on the basis of their terms at original inception and without regard to the remaining lease term from the acquisition date. So the classification will be based on original inception. Thus, in particular, if the acquiree has appropriately treated a lease as a finance lease, that lease will also be treated as a finance lease in the consolidated financial statement, even if majority of the lease term has expired before the acquisition date. So the summary of this big paragraph is, you will follow the same classification which the acquiree had followed. Okay, don't change it now. Now, what is the distinction between operating and finance lease? This standard gives you 5 concluding evidence. How many? And 3 additional indicator. If you come across concluding evidence, then it is sure shot a finance lease. It is definitely a finance lease. But if you come across additional indicator, it is not sure shot finance lease, but there is a high probability that it may be a finance lease. So you have to investigate further, go deeper and conclude finally whether it is a finance lease or not. But they are strong indicators. For the purpose of lessor, the leases will be of 2 types, finance lease and operating lease. There is no such classification for lessee. Okay. So what is a finance lease? A lease that transfers substantially all the risk and reward incidental to the ownership of the underlying asset to the lessee. Is it right? Now this standard uses the same definition which was used in the previous version of this standard. Risk and reward. Now, why they have used the word substantially all the risk and reward? Substantially all means may not be all. Some risk and reward may still be with the lessor. For example, residual value risk. After 5 years are over, the lessee will return the asset. And by that time, the residual value would have fallen more than what your expectation was. So, who is going to bear that risk? Lessor. But that is a small risk. But other risk like asset will not utilized, asset might become obsolete, those risks are borne by the lessee. And returns are also enjoyed by the lessee. If the asset generates output, more demand, higher price, more profit from that asset, who will enjoy? The lessee would enjoy. So how to check whether it is a finance lease or operating lease? One main test is whether significant risk and reward of ownership has been transferred or not. Examples given in the standard are risk example of risk. Asset may remain idle. Change in technology may make the asset obsolete, and the variation in the future economic benefit expected to flow to the entity due to changing economic conditions. An example of reward, an expectation of profitable operation, a gain from appreciation in the value, or realization of residual value. In some cases, the asset will be sold back to the lessee. In that case, that is also a gain which the lessee would enjoy. So, significant risk and reward test you have to apply. In addition to that, they have given you 5 concluding indicators and 3 additional indicators. The standard emphasizes that while deciding whether a lease is a finance lease or operating lease, applies substance over form criteria. Okay. And to help you, to guide you, they have given you some indicators. So we will call them primary indicator, additional indicator. Primary indicators are concluding evidence, and additional indicators are also relevant for decision making. But additional indicators are not concluding evidence. Sir, give me 5 examples of primary indicators. If you go to interview tomorrow after you qualify, and they will ask you which is your favorite standard, you will say leases. So then they will ask you, how do you identify a finance lease from lessor's point of view? Give 5 examples. 1. The lease transfers ownership of the underlying asset to the lessee by the end of the lease term. This is one of the most foolproof example. It is as good as is going to buy the asset. So lease rental paid plus he will buy the asset ultimately becomes to the owner of the asset ultimately passes to the lessee. So this is the primary indicator number 1, and this you can say is the most soundproof example. Okay, foolproof example. And why it is like that? I use the word soundproof instead of foolproof. Okay, sound example. Why it is like that? Then there is a comment also in the note. You will read yourself, or should I read? Why ownership transfer is a primary indicator. A lease can be considered to transfer ownership of the underlying asset when transfer of legal title, and thus continued ownership of the risk and reward is automatic under the lease agreement or under a side agreement that forms part of the overall lease arrangement. That is when the lessor has entered into a separate forward sale agreement with the lessee. Either it can be within the lease agreement or it can be a separate agreement. But the fact that the ownership is transferred means all risk and reward has been transferred to the lessee. What is the second primary indicator, which is similar to the first one only? But instead of compulsorily transferring the asset to the lessee, it gives an option to the lessee. The lessee has the option to, each and every word pay attention, the lessee has the option to purchase the underlying asset at a price that is expected to be sufficiently lower than the fair value at the date of the option becomes exercisable, such that at the inception date, which date? Inception date, it is reasonably certain that the option will be exercised. Now here some subjectivity may get involved, but again it is a principle based standard. One has to apply the judgment carefully. A Mercedes car is given on lease for 5 years, and an option is given to the lessee that he can purchase it after 5 years for a sum of rupees 1 lakh. Okay, check whether the option is certain to be exercised. Do you think the option will be exercised? A 5-year-old Mercedes car being available for 1 lakh rupees. So it is expected to be sufficiently lower than the fair value at the date the option becomes exercisable. Of course, you will exercise. Then one student asked me in some earlier batch, what if he does not require a Mercedes car after 5 years? If you don't require, then still you buy it and sell it in the market for 25 lakh rupees, 20 lakh rupees, whatever. At least you'll make some gain out of it. Okay. I don't know from where their creativity arises. What if he does not buy? You are a commerce graduate. you should be thinking that even if I don't require, if it is available at a lower price, buy and sell it. Third is, the lease term is for the major part of the economic life of the underlying asset. Now again, this is a principle based standard. So it uses the term major part of the economic life of the asset. Major part of the economic life of the asset, even if the title is not transferred. Now, how do I verify this? Two subjectivity to my knowledge gets involved here. First is, what is economic life of an asset? Is it a certain number? Depends. Which bike do you use? Excess. What is the economic life? 8 to 9 years. 9 years you are going to use that vehicle. After some years, instead of you going on the vehicle will go on. Anyway, 9 years. But that is very subjective. Many people just use it for 5 years and then they dismantle it or dispose it. Okay. Major part. What is major part? So major part, is it more than 50%, more than 75%, more than 90%, more than 95%? It is left to your judgment. It is left to your judgment. Okay. So no strict rule here, but generally, remember, generally 75% can be taken as a benchmark here. Generally 75% or more period is covered by lease term, you can assume it is a finance lease. So 75%. And the fourth is, at the inception date, the present value of the lease payment amounts to at least substantially all of the fair value of the underlying asset. Now you see this word, at least substantially all of the fair value of the underlying asset. Again, there is no benchmark given in the standard. But what you can do, you can say roughly, approximately 90% of the fair value of the asset, if recovered through your lease payment, then one can conclude that it is a finance lease. But 90% is not the standard as given. It is what in practice we use that number. Okay, for checking whether the fair value is recoverable from the lease payment or not. If you are able to recover 90% or more of the fair value from the lease payment, you are actually receiving the installment from the lessee. Is it right? And the fifth one is also a very easy one. The asset is of a specialized nature, such that only a lessee can use it without major modification. So the asset was customized, designed, manufactured, constructed for a specific lessee. Others can't use it. If others can't use it, of course the lessor would invest in such asset only if he can recover the cost and the time value of money from that asset. Is it right? Why would otherwise you give an asset on lease to somebody which can't be used by others? And you can't recover it from one party. So therefore such leases are bound to be finance lease. Okay. And what are additional indicator? Why I have written it separately as additional indicator, next 3 points you will see. Because these are not concluding evidence, but they are indicating, hinting that it is or it may be a finance lease. Okay. So these are strong indicators, but not concluding evidence. If the lessee can cancel the lease, the lessor's losses associated with cancellation will be borne by the lessee. So that means there is a heavy cancellation penalty. Second, gain or losses from fluctuation in the fair value of the residual accrues to the lessee. if lessee is going to bear the residual value loss, lessee is not the owner, but in some or the other way he is supposed to bear the residual value loss, then it is an indicator of finance lease. And next, the lessee has the ability to continue the lease for a secondary period at a rent which is substantially lower than the market rent. Let us say, for example, it is a 10-year lease term. First 5 years the lease rental is 1 lakh per annum, and then next 5 years it is only 2000 per annum. Why you are laughing? It is possible. The lessor must have recovered the entire amount in the first 5 installment only, and then all this is just formality for some or the other reason. Is it right? He must have recovered the cost and the time value of money in the first 5 years only. So it is a clear indicator, not clear, at least it's a very strong indicator that this lease may be a finance lease. So when you are reading a lease agreement, check for these indicators. 1, 2, 3, 4, 5, first 5, it is a finance lease. 6, 7, 8, there is a high probability that it is a finance lease, but then you have to find out from the management, is it really a finance lease? Now come to leases of land and building. Same like your previous standard. Okay. You may enter into a lease of land and building. Should we account it as one lease or should we account it as two lease? Okay, that is the issue. Again, you may have paid only one consideration or you will receive one consideration. We are looking at from lessor's point of view. So you may receive only one consideration. Then how to allocate the consideration between the land and the building? So these are some issues which may arise when you take the entire land and building on lease. So 4 or 5 key points we will understand. I don't think they will ask a numerical question here, but a theory question can be asked. Accounting treatment of lease of land and building. When a lease includes both land and building, lessor should assess the classification of each element as a finance lease or operating lease separately. So your effort should first go to check there are 2 elements, okay, land, building, whether both are operating lease, both are finance lease, or is it possible that land may be an operating lease but building may be a finance lease? Possible? Can we have 2 classification for land and building? Yes, you can have. Land normally would be operating lease. Normally, but not necessarily. Land can be a finance lease also, but land normally would be an operating lease. The reason being that land has an indefinite economic life. You have just now read, lease term covers major part of the economic life, but land has got indefinite economic life. So even if it is a lease for 50 years, 50 divided by indefinite is again 0. Okay, but not always. It can be a finance lease also because other condition can get satisfied. The lease rental present value may become equal to fair value of the land today. Then it can be a finance lease. So leases of land are assessed in the same way like any other lease. Normally land has indefinite life, so it is unlikely that lease term will be for major part of the economic life. But other characteristic described above may make a land a finance lease. Like for example, the lease rental that you pay or receive the present value may be equal to fair value of the land. So that condition can get satisfied, and therefore a land may be a finance lease if the present value of lease payment is equal to or substantially equal to fair value. In particularly, at the inception date, the present value of lease payment, if it is substantially equal to all of the fair value, then land may be a finance lease. So now we have suppose decided that land and building are two separate components. We'll have to split leases of land and building. Each will be evaluated independently. Each will be evaluated independently. Whenever necessary, in order to classify and account for a lease of land and building, a lessor should allocate the lease payment also. Now see, if you have decided that land is a separate lease, building is a separate lease, the consideration received will also be accordingly allocated for accounting purpose. The consideration will also be allocated for accounting purpose. So, on what basis you are going to allocate the consideration? The consideration will be allocated in the proportion of relative fair value of leasehold interest in the land element and building element of the lease at the inception date. So, according to fair value of leasehold interest in land element, fair value of leasehold interest in building element, both figures calculated on the inception date, and in that ratio the consideration received will be allocated if you receive a common consideration for both. If the lease payment cannot be allocated, next principle, if the lease payment cannot be allocated reliably between the land and the building element, the entire lease will be classified as finance lease. If you can't allocate between the land and the building element consideration, then the standard says you treat that the entire lease is a finance lease unless it is clear that both elements are operating lease. Now suppose the lease is only for say 3 years only, then in that case you can treat both land and building are operating lease. Okay, in which case the entire lease is classified as operating lease. Point number next, for a lease of land and building under which the amount for the land element is immaterial. Now this is for simplification of accounting. If you have taken land and building and assuming land element is immaterial, land element is immaterial, not material, then there is no need to split. Treat the entire lease as one only, and it will be called as land and building may be treated as a single unit for the purpose of lease classification. In such cases, the economic life of the building will be regarded as economic life of the entire underlying asset. So if you want to apply whether it is a finance lease or operating lease, whose economic life I will take? I will take the economic life of building. You just merge the land in building only if the land element is immaterial, not material. So that is for lessor, splitting the lease of land and building. Now the next part of this chapter is sublease. What is sublease? Now there is a double role of a person. Have you understood double role? This is suppose A Limited. Okay. What it does, it takes an asset on lease from X Limited. So this we will call head lease. And what is the status of A Limited here? Lessee. A Limited is lessee. But the same asset, if the terms of the lease allows, is leased to another company, Y Limited. So this portion we will call sublease. And what is the status of A Limited in this transaction? Lessor. So A Limited is a double role player now. He is a lessor also. He is a lessee also. So with respect to this portion, he will have to do the accounting of lessee. Whatever lessee has to do, we have already learned. And for this portion, he will have to do accounting as a lessor. That is also we have learned, or we are yet to learn. Is it right? Why we have not learned so far? Accounting by lessor is in the next paragraph. Doesn't matter. So this is my discussion now. So this person A Limited, we will call him intermediate lessor. What he will be called as? Intermediate lessor. What is intermediate? He is actually a lessee, but in a sublease transaction, he becomes lessor for the sublessee. Is it right? Is required to account for head lease and sublease as two separate contracts. So you will have to continuously now apply to accounting. As a lessee also, what I was supposed to do, I will do it. And as a lessor also, what I am supposed to do, I will do it. Applying both the leases and lessor accounting requirement. Okay. Good news, there is no illustration on this, otherwise, no numerical illustration, otherwise it could have become complicated. So this approach is considered to be appropriate because in general, each contract is negotiated separately. There are contracts with two parties and those two parties are different parties. Will it be the same party? Chances are rare that you take the asset on lease from one party and again give it to that same other party also, with the counterparty to the sublease being a different entity from the counterparty to the head lease. For head lease, X Limited is my counterparty. For sublease, Y Limited is my counterparty. Accordingly, for an intermediate lessor, the obligation that arise from head lease are generally not extinguished by the terms and condition of the sublease. So dear student, you must have understood by now that A Limited will have to do two accounting. One as a lessee and one as a lessor. As a lessee, there is only one accounting system. Which is that accounting system? Right of use asset account debit to lease liability account. Correct? So even if you have given this asset on lease, the lease liability account will be accounted in the same way we have learnt earlier. Interest entry you will pass, payment entry you will pass, okay, remeasurement entry you will pass if required. And with respect to this as a lessor, I will have to check whether this lease is an operating lease or a finance lease. Okay. Because as a lessor I have two types of leases. So maybe I have taken this asset on lease for 20 years, but for 1 year it was empty, I was not requiring it, so I gave it to somebody else. Okay, you can use it and give me some amount. So that becomes an operating lease. I have taken this lease for 20 years and I again passed it to other party for 20 years, 19 years. So then that will also become a finance lease. Is it right? So now the standard discusses both the situation, when the sublease will result into finance lease and when the sublease would result into operating lease. Which one is easier to handle, guess? operating lease, whatever you will receive from the sublessee, account it as income in P&L account, matter closed, no further discussion. This will continue as it is. Your original accounting for this part will continue as it is. And if it is an operating lease, just receive lease income and recognize in profit and loss account. But if it is a finance lease, then you will have to de-recognize this asset and recognize net investment in the lease. Net investment in the lease account debit to right of use asset. Difference will be transferred to profit and loss account because this will be based on different set of calculation. Understood, or you want me to read further? You understood? So today you will read the sublease part. Say yes or no. Okay. Now we'll continue tomorrow.